a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. Dissent at the Fed. More than one governor may break rank in today's decision as President Trump intensifies the pressure. And it's a mega earnings day. $7.6 trillion in market cap will be reporting. Results include Microsoft, Meta, and Qualcomm. And just 2 days away from President Trump's tariff deadline, we await deals with China and India. Well, we finally broke the winning streak of 6 days that also brought with it 6 consecutive records. We move higher again today. It's been a very mixed earnings bag that has been weighing on just how successful these indices have been. You're looking at an S&P that's it'll change this morning, up about 1/10 for the NASDAQ. For the bond market, it was a powerful rally, really being brought about first by jolts. But this narrative started to evolve. Are we going to get a quarterly refunding announcement today that does something to cap yields? You can see some of those gains reverse. It is yields higher this morning by about 1.5 basis points for your 10-year yield. That is trading at 4.33. It's a busy day of earnings, of a Fed decision, of data. Before all that, though, let's look at some of the stocks moving in the pre-market. With that is Valerie Teitel. Hey, Val.
Hey, Danny, let's start with Starbucks. Out with earnings after the bell yesterday. Came in with a beat in net revenue, and their sales numbers looking good in their key markets of North America and China. Those shares are rising 4.6% in pre-market. The new CEO's turnaround plan looks like it is proceeding on schedule. Next, let's move on to Visa. They failed to raise their guidance, seeming to disappoint investors. Those shares are down close to 2% in the pre-market. The CEO did have some positive news on U.S. consumer. Saying consumer spending remains healthy, both in discretionary and non-discretionary buckets. Let's move on to Europe. We did have a lot of European banks reporting earlier today. The big one, HSBC, Europe's biggest lender, disappointing on profit. Those shares are declining nearly 3%. And then lastly, UBS, a bit of a different picture here. They did come in with a beat on profit. Those shares are in the green, with the CEO saying some really positive comments, Danny, saying that their clients are ready to deploy capital, that their deal pipeline looks healthy as this uncertainty around the economic outlook has dissipated. Danny.
Valerie, thank you very much for that. We'll catch up with you later in the hour. Also this hour, we'll speak with Kit Juckes, SocGen, who will join us for his view on the dollar and where we go from here. Later, we'll also count down to the Fed decision with Priya Misra of JPMorgan. Now, trade headlines this week have sent the euro weaker, the dollar stronger. Markets still awaiting more clarity as we get more deals in the pocket. Kit Juckes of SocGen writing, the right market position in August is no market position, especially this August. But the danger is dollar shorts turn into dollar long as U.S. exceptionalism is reinforced. I'm pleased to say Kit Juckes, Chief FX Strategist at SocGen, joins me now. So, all right, Kit, I'm ready to just pack things in and go to the beach, given that. But it does seem like the pain trade is kind of here this week. We saw the long end, for example, have a powerful rally yesterday. The day before that, it was $1 long. Are we off sides heading into what is bound to be a volatile and thinly traded summer?
Well, we're definitely skewed in terms of our positioning, so we can probably go both ways, which is particularly scary. Yeah, look, what we know in the market is that there's been a lot of dollar selling, particularly euro and yen buying over the last few months. So the market has a big dollar short. The professional market, on the other hand, has tended to be long in terms of options positioning dollars. So we have a mix of those positions. And then against all of that, of course, we'd started to see for the first time some hedging of US dollar exposure from the long-term investor community that's been buying US stocks. So there are quite big positions in different places. The one that's getting squeezed out because of the perception that the Europeans caved on tariffs, for want of a better way of putting it, was clearly the euro-dollar position in the market. And that saw us fall faster over the last 72 hours than most people had expected, after having gone up higher than pretty much anybody had expected. So we can squeeze that one out. I don't know how far we can squeeze the bond market. I've always thought the thing with the bond market is that there will be supply and it will come and someone will have to buy it. But yes, in FX, I mean, frankly, we could be at 120 or 110 at the end of the summer. I wouldn't be that surprised. It's a question of navigating the news pretty carefully.
It's a perfect encapsulation of just how confused and how many cross currents there are right now, Kit. But when it comes to the euro, you said the EU is perceived as having caved in. How do you actually understand how we evolve from here, whether there is some real economic damage to come from the EU because of the deal that they reached with the U.S., and what that means for whether a trend of a strengthening euro is broken at this point or simply just disrupted?
I think there's two parts of it. And firstly, the best estimates I've seen of what the effective tariff rate is at this point in time is that it's gone to 11%. From about 10, because the tariff deals have lots of things that don't have tariffs, some things that had higher tariffs, and so we get this headline announcement. In the end, it doesn't move the dial as much as it moves the sense. And I'm with everybody else. I'm disappointed by the way the negotiations have been so one-sided. But so you had a pretty big market reaction to in terms of disappointment. I don't think the economic impact is anything like as significant as that. That's going to be determined by lots of other things. So we'll see what happens with the European data. Meanwhile, I think the big story is still to come in twofold. One, the U.S. economic story. Do the tariffs get paid by exporters or producers, exporters, importers, consumers? The more the U.S. consumer pays for these tariffs, the more the U.S. economy is going to end up having to slow as disposable income is hit. We're not even going to know this for months. That's the first big thing. And then there's this piece about, let's call it Fed independence, but let's see how Fed policy evolves from here with massive uncertainty about inflation and some signs of some slowing in the economy, but not enough signs to scare anybody.
I'd love to break down those two separate thoughts, Kit, but if we just start with the Fed, because we have the decision today, we may get two dissents, the first time that's happened since the 90s. How do you expect that to change things at all if we do get a decision that has likely Waller and Bowman dissenting?
It just increases the talk about what happens next. I mean, there's no. I don't think you can make an economic case, not a serious one, for cutting policy now ahead of the way that tariffs have played out. The economy is too strong to justify easing policy at this point of view. Would I think be a sort of pretty broad consensus view from everybody outside the United States anyway. So if you get a sense that policy is being politicized, I don't know that you get a massive reaction straight away from two dissents. That's not huge, but it adds to this sense that President Trump wants lower rates. President Trump wants a weaker dollar. If officials start to support that against what the economy is doing, then it's a big threat to the international investor community, which fundamentally has been driving the dollar higher for the last goodness knows how many years.
Part of the curiosity, though, Kit, is it's a Chair Powell who usually is pretty successful in stitching together some sort of consensus. If we don't have that clear consensus, if we don't have what many have said has been groupthink and maybe welcome some dissents, but if we don't have that, does that muddy the message that we're likely to get from Powell today?
I think the message is muddied by any kind of dissent only in the sense that the message is politicized. So we know what the Powell message is, and if it were a completely united Fed arguing to the U.S. administration that we can't realistically cut interest rates while there's this much inflation uncertainty out there, and while the economy's not doing that badly, let's not exaggerate the weakness that we've seen in small pockets. If that's a united front, it tells one story. If there start to be cracks in that, it just adds to this sense that the U.S. administration wants to politicize monetary policy.
So, Kit, if we need to wait to see what the impact to the economy is as to who's paying for tariffs, what inflation looks like, what is your sense of timing? When can we come back from the beach? When should we come back from the beach for those who have gone and start to pay attention?
We should absolutely be back from the beach in time for the August payroll data at the beginning of September. September is always the most exciting and important month in financial markets. August is always dangerous and difficult and all sorts of things happen. I have big principles on this stuff. Definitely you need to be back from the beach in your office in the first week in September. But and then we'll see where it goes. I think for now, we're just going to react. We're going to overreact to each piece of news, and it's going to make it very difficult.
What about the timing and just the sequencing of things, Kit? Because maybe you start to see some of that economic weakness or inflation or what have you at the end of the year. But then in the start of 2026, you get The one big beautiful bill starting to take hold. You have what's expected to be more deregulation. Does that yet again confuse just where we stand and how loose or tight conditions are for this economy?
Look, if the U.S. economy comes out of this into next year with, let's say it comes out of this with looser fiscal policy and the tariffs haven't caused a really big amount of economic damage, then the bottom line will probably be that the peak level for the euro or the lowest level for the dollar in this cycle is somewhere around the end of this year. But, because in the end, what we've got is an environment where the rest of the world has invested far too much money with far too small foreign exchange hedges on it into the U.S. economic dream, and is now nervous. If it transpires that the U.S. economy can kind of reverse that nervousness and uncertainty and come into 2026 looking like it's going to come out with, let's call it a slowdown that isn't a recession and pulling away after that, then I'm just going to have to come back from the beach, see how much money I can make being short of the dollar in the fourth quarter of the year, and then get long dollars at Christmas.
Kit, you are our favorite travel agent. Thank you so much for coming on the show this morning. Kit Juckes, hopefully you're off to the beach after this. Great to see you. All right, let's get you some other top stories that are trending on the terminal this morning. And the Aston Martin Formula One team will be valued at around $3.2 billion in its latest stake sale. CEO Adrian Hallmark said that the team's listed car maker has agreed to sell its minority stake in the team for nearly $150 million. He declined to name the buyer, saying the deal had yet to complete. Mercedes-Benz and Porsche are scaling back profit expectations for the year as President Trump's trade war takes a toll on the luxury car makers. The two German firms are also highlighting intensifying competition in China, where an EV price war is hurting demand for its pricier models. Shares of Hermes, meanwhile, are falling despite a sales increase. Concerns over the stock's valuations overshadowed the better-than-expected second quarter results. The performance of its share price this year is quickly moving towards the average of the sector. Coming up, the third round of U.S.-China trade talks are done. We're going to bring you the takeaways with our reporters on the scene. That's coming up next. This is Bloomberg.
We don't want to decouple. We just need to de-risk with certain strategic industries, whether it's the rare earths, semiconductors, medicines, and we talked about what we could do together to get into balance within the relationships.
Treasury Secretary Scott Bessent speaking in Stockholm after the third round of trade talks with his Chinese counterparts. For more details on the meeting's outcome, we're joined by Oliver Crook, who is in Stockholm, and Brendan Murray, who's tracking that and other trade deals, who leads our global trade coverage for us. Oliver, let me start with you. What has been the outcome of day three?
Yeah, there was a little ambiguity around that, Danny, after these sort of 2 days of meetings wrapped between Scott Bessent leading the U.S. delegation, flanked by Jameson Greer, the U.S. trade representative, speaking with the Chinese vice premier here in Stockholm for 2 days on trade negotiations. The ambition was to get a truce prolonged between the United States and China in the trade war that they sort of prompted earlier in the year, where you saw tariff rates exceed 100% in each direction, basically precluding any trade between the two biggest economies in the world. The ambition here was to extend the deadline, which is August the 12th, for that truce to continue. We had a press briefing first from the Chinese, who seemed to have indicated that that was a done deal, that was locked in, and then a little bit later hearing from Scott Bessent saying that no, we're not quite there yet. We're waiting for the final sign-off by Donald Trump, who will be briefed today by the delegation that was here in Sweden about whether or not he's going to extend that truce. Longer term, Danny, there's a lot that has been made about a possible meeting between Xi Jinping and Donald Trump at some point in the near future, though I have to say in a number of the conversations that we heard from Scott Bessent yesterday, saying basically that there wasn't a huge amount of progress, it seems, on some of the other key issues that the United States and China have to work forward to. So it's hard to imagine a meeting between these two men in the absence of having anything really to deliver. And I suspect that this is a relationship that is going to continue to make progress really with 90-day increments. So I think that for the market, generally speaking, the expectation is you will get an extension of that truce, despite the fact that they did not strike it here in Stockholm. That's why you've seen the markets be relatively calm about all this. But But again, in terms of longer-term progress, I think this is a long road that we're going to be kicking the can down for the months to come.
Brendan, to Oliver's point, it needs a final sign-off from Trump. But just because Trump has the final sign-off doesn't mean that more work needs to be done. The EU is a great example of this, of Howard Lutnick saying yesterday that still plenty of horse trading is left to do. Read the EU deals. Brendan, what is left to be negotiated? What are still the unknowns a few days out now from actually getting that deal agreed upon?
Well, the deals that we've seen so far, whether it's the EU or Japan, are broad frameworks. They're kind of ambitious goals that the two sides agree to with big numbers. But the more you dig into them, the more unachievable they look, and the more details there needs to be hashed out, and important details in terms of the rate of tariffs that are going to be applied to sectors and broadly on these various economies. So what we're expecting over the next 48 hours before the Friday deadline is the three big deals that could still come together in Asia are India, South Korea, and Thailand. There are indications that those are still moving in the right direction, although Jamieson Greer, the U.S. Trade Representative, said that India still has some work to do. And then in Europe, there's a Swiss deal that the Swiss are trying to get over the line. Pharmaceutical tariffs are a big issue for Switzerland. So we'll have to see. It's going to be a furious 48 hours for the White House to codify these tariffs and get them in a place where they can be implemented on August 1st. And in the meantime, you've got a lot of chaos out in the business community that doesn't really know which direction the tariffs are going and whether they'll be kicked in on August 1st as the president has promised.
Even though we've seen these tariffs be placed on, these agreements happen without any reciprocal tariffs, retaliatory tariffs rather, from other nations. Oliver, given the U.S.'s position and its ability to get these deals, broad frameworks, let's call it, agreed without any kickback, without any pushback from these countries, how does that color the U.S.'s standing as it speaks with China?
Well, I think that's really interesting, Danny, that precise point, because you look at the deal that you got with Japan and the United States, the EU, the United States, the UK and the United States. In all of those sort of conversations, the dynamic there is that the other side of the table, whether it's the Europeans, the UK and the Japanese, as sort of Brendan was alluding to, they want to appear to be giving Trump more than they really are, right? There's these hundreds of billions of dollars pledges. These things are going to be very hard to monitor. How much of it is stuff that's already been pledged? All of these sorts of things. You have basically the exact opposite dynamic with China, where China has been building itself up over the last few decades economically, its status on the global stage, and it is basically unwilling to bow to the demands of the United States, as we've seen in the last couple of times. And I'll just make one final point here. The first time you saw these trade negotiations and Trump won, the Chinese delegation went to Washington, D.C. In Trump 2, they're in Geneva, the UK, Sweden, third-party neutral countries.
Oliver, thank you very much for that. That is Bloomberg's Oliver Crook and Brendan Murray. Coming up, we're going to take a look at the front pages this morning. That includes a tsunami warning for the west coast of the United States and parts of Russia and Asia. That's coming up next. This is Bloomberg. Let's take a look at the front pages this morning. First up, it's Fed Day, and the Wall Street Journal is looking at the potential for Fed governors to break rank. President Trump has been cranking up the pressure on the central bank and Fed Chair Powell to cut rates. The Fed is expected to hold today. Next up, the FT reporting that the German economy shrank 0.1% in the second quarter. The print was in line with expectations, but it does mark a slowdown from 0.3% growth in the first quarter. And on the New York Times front page, a tsunami waves reaching Hawaii after the biggest earthquake since 2011. The 8.8 magnitude quake has also prompted warnings and evacuations in Alaska, California, and Japan. For more on this, we're joined by Bloomberg weather and climate reporter Joe Wertz. Joe, what's the latest?
Well, like you said, those waves have hit Hawaii and California. They've been moving across the Pacific since that quake started. broad tsunami warnings were issued across the region, but we're starting to see some of those get downgraded. Some canceled outright. Ones in China have been canceled. Some of the ones in Hawaii have been downgraded to advisories. So we're hearing that while there still could be some potential impact, the biggest fears of damage or disruptions from these waves seem to have been missed. No major disruptions or damage reported so far.
Joe, is there understanding that there's still evacuations in places? Where does that still exist? Where are still the risks?
Yeah, still some evacuations, still some ports being shut down, some energy infrastructure and things like that were evacuated as a precaution. So those are still ongoing throughout the region, and authorities have been out early and loudly trying to keep people away from the coastlines and off the beaches, and have advised that it's going to be a little bit before they start giving the all clear signals. So some of that those evacuations and disruptions still in place, but we're starting to see those get canceled and the situation be downgraded a bit.
Joe, thank you very much for that. That is Joe Wirtz. A quick check on your bond market this morning, and we are looking at yields pushing higher, but that was after a powerful rally yesterday. We're up by a basis point and some for both the 10-year and the 30-year yield at 4.33 for the U.S. 10-year yield after softer JOLTS data, and a look forward to a quarterly refunding announcement and a Fed decision today. Coming up, we're going to speak with Priya Misra of JPMorgan on that busy week and how to hedge risk assets for that. That's coming up next. Stay with us on your brief. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. Dissent at the Fed. More than one governor may break rank in today's decision as President Trump intensifies the pressure. It's a mega earnings day. $7.6 trillion in market cap will report, including Microsoft, Meta, and Qualcomm. And just 2 days away from President Trump's tariff deadline, we await deals with China and India. Well, we broke the 6 consecutive days of gains and 6 consecutive days of records. We push higher this morning ahead of big earnings, again, from Microsoft and Meta. We get Apple, we get Amazon the day after. Plenty of risks ahead. The NASDAQ 100 outperforms, up 0.1%. Meanwhile, the big rally in this bond market takes a breather, the best day for duration since June, but we move higher by more than a basis point, nearly 2 for the 30-year yield. Yesterday was marked by, yes, softer JOLTS data, but also perhaps some questions into the market about what we might get from a quarterly refunding announcement today. We also have a Fed decision today and GDP data. There is a lot, but let's look at some of the stocks moving in the pre-market. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with Starbucks. Out with earnings after the bell yesterday. Came in with a beat in net revenue and showed some decent sales numbers when it came to their 2 key markets of China and North America. Those shares are rising near 5% in pre-market trade. Maybe this is the first signs that the new CEO's turnaround plan is starting to work. Let's move on to one of the losers from the earnings last night, and that's Visa. Those shares are down near 2% in pre-market trade. They failed to raise their guidance, which is causing some disappointment among investors today. But the CEO did have some positive things to say about the health of the U.S. consumer, saying that we're seeing resilient spending when it comes to discretionary and non-discretionary spending. Lastly, let's end on a check on some European banks. We did have a fair few amount reporting earnings in Europe this morning. HSBC, Europe's biggest lender, came in with a miss due to rising expenses. Those shares trading down 2.5% in London. And then the Swiss giant UBS, that came in with a beat when it comes to their profit. Those shares are rising sub 2% in trade in Switzerland, with the CEO saying that their deal pipeline, their clients are ready to deploy capital now that economic uncertainty has dissipated. Danny.
Valerie, thank you very much for that wrap up. And it is a huge week for markets. The earnings will continue. Valerie mentioned the ones we've already got, but we also have 4 Mag 7 names out with results. $11 trillion of market cap report today and tomorrow. But that's not it. We also have a Fed decision. We have the July jobs report. We have a tariff deadline on Friday, by the way. We also have GDP data today. There's PCE out this week. There's so much. JPMorgan Asset Management Portfolio Manager Priya Misra writes, this is one of the most macro weeks of the year. Any weakness in the incoming economic data threatens all markets, and we think owning some duration is an attractive way to hedge risk assets. I'm pleased to say that Priya joins us in the studio now. Priya, really wonderful to see you this morning. Wow. So with all of that, between earnings, between data, between a Fed decision, more trade deals, what is the biggest risk, do you think, of this week?
I think it's really the jobs data. So I'll be watching ADP, I'll be watching claims, and then the all-important payroll report on Friday. You know, because we have seen some slowing in payrolls. I think there's a big question, how much of it is immigration? How much of it is just noise in the data? Is there some seasonal component? We saw that last year. But are we seeing fundamental slowdown? Because remember, even the debate at the Fed is all about risks to both sides of their mandate. The Fed's been really concerned around the inflation side of the mandate. I think the market's pricing that in and not really pricing in any risk to the growth side. You start to see that the payroll numbers are slowing down, that it's still concentrated in a couple of sectors, but the overall pace of hiring is slowing. I think the market might start to worry about the other side of the mandate. And then I think the soft landing narrative that I think is embedded in every market, that starts to unravel. So that is, you know, as you said, there's a lot this week that we're all trying to keep an eye on. But I think it's the jobs data that's most important.
If there is weakness and the soft landing narrative starts to unravel, how vulnerable are we with stocks at an all-time high and credit spreads incredibly tight?
So I had a client actually tell me yesterday, well, the Fed's going to cut. And yes, I do think the Fed's going to cut. I think they're very credible if they see signs of that downside risk. But here's the issue. Interest rates are still restrictive. How much do they need to cut to get into accommodative territory? We can debate what's neutral. Is it 3, 3.5? We're at 4.5. So there's a lot of, they have to cut a lot, and they'll want to see what happens on the inflation side. So the speed of those cuts may not be as much as I think risk assets might want. And then there are lags to monetary policy. We saw it on the way up. So I do worry about risk assets. I think there may be this hope that, oh, the Fed will cut, but you're not going to get much on the fiscal front. And so if we are slowing down, I think you'll get a pause and some of the risk premiums should rise. And, you know, that means wider spreads, that means weaker stocks. And it doesn't need to be recession. It's just a slowdown, I think, closer to 1% in GDP. I think that might make the market a little nervous, and that's why I think having a well-diversified, balanced portfolio, that's why bonds should play the role. And I know we've debated correlations. I think the last time I was on, I was saying, I don't know, correlations are unstable. We're seeing now more signs that correlation's coming back because the Fed will be in play. That helps. The Sell America trade, we've seen the auctions. They've been fine through this period. Foreign demand still strong. You know, domestic demand's been extremely strong as people are saying, if I can get 5.5%, 6% in high quality spread product, all in yields with lower volatility, it's attractive. So I think that's why that correlation will hold. So if you have risk assets on your portfolio, just own some duration in case the economy does slow down more than it's
Well, duration had a fantastic day yesterday, Priya. There has been some chatter. Maybe we get something from the quarterly refunding announcement that helps to cap yields. Do you think that's a move this administration would make?
I think not yet, because we still have a deficit issue. We still have very high funding needs. I think what the market is looking for is the message, is the reading between the lines. Is the deficit a little better because of tariff revenues? I think the market looked at OBBB, the One Big Beautiful Bill, and said that's a 6 trillion bill or a 5.5 trillion bill in terms of total deficit. Well, how much do the tariffs come in? If 10 or 15% is the new zero in terms of tariff, that's a tariff revenue of 300 billion or so per year. That's 3 trillion over 10 years. If this is the new normal of having 10 to 15% tariff rate, then the deficit picture might be a little better. So we'll watch at 8:30. Does the Treasury acknowledge it? That actually the deficit picture is not as bad. And then does TBAC or Treasury start talking about where do they issue it? And I think if they just signal that there's more demand in the belly of the curve, which I would agree. I think demand in the long end is not that high. Pensions and insurance are there, but that's not growing. The marginal demands in the front end, will Treasury skew that issuance in the front end? I think that's what the market started to price in a little bit. I don't think you're going to get any definite announcements today at 8:30. They can just keep auction sizes the same, but we'll be watching for that messaging. You know, do they say, well, actually, the deficit, I know everyone's concerned, It's not as much of an issue. You don't have to issue as much in the long end. I think some of that fiscal fear is priced into that long end. I think we started to see some of that come off. But I don't think you're going to get some big announcement.
Are you expecting any distortion in the curve, especially on the front end, when you get legislation with things like stable coins that needs to be backed by those cash-like instruments? Are you starting to see that? Are people preparing for that? Will it have a lasting impact?
I think it's another source of demand. And you know, whether banks, so we had the SLR relief, banks might end up buying more, again, 0 to 5 year treasuries. You raise a great point, stable coin. I mean, let's see, is that worth $1 trillion? TBAC has said could be as much as $1 trillion of demand. We haven't seen it, but I would argue if Treasury has to issue, and this is, you know, the Treasury should always be looking for the lowest cost of financing for the taxpayer. If there's more demand in the front end, whether it's coming from stablecoin or banks, they should issue more in the front end. So I think we'll see this over time. Let's see how much stablecoin demand picks up. But I think they're smart in trying to find new buyers, domestic buyers of treasuries. If foreign demand is going to be a little bit less, well, where's that demand going to come from? I think stablecoin and banks might be the place.
So, Priya, when we get a Fed decision today, there is a chance that we get 2 dissents, the first time since the 1990s. It's a Fed Chair Powell, who for his term has been very good at cobbling together a consensus. What happens if it's that much harder to do it this time around?
So I think 1 or 2 dissents is priced in. I mean, Governor Waller's speech was, I think, the first time I've seen a dissent before the meeting. I think he effectively did that. Now, it's possible that you get more than a couple of dissents, but look at how extraordinarily uncertain the economic outlook it is and the risks to the outlook is. And so I think the dissent is priced in. I don't think it looks that political because Governor Waller, and maybe you'll see this from Governor Bowman, have highlighted that they're more concerned about the risks to the labor side of the mandate. They're in the team transitory, and as somebody who was part of team transitory a few years ago, I have some sympathy for that view. Tariff inflation tends to be often one-off. And you look at service inflation in the last few months, it's been weaker. Does Chair Powell get a little bit of a consensus and doesn't get those dissents? I think that is a chance that you don't get those dissents because he highlights that maybe the risks to inflation are not that high. Remember the June meeting, or even before that, they were highlighting that they're more concerned about the inflation side. And I think if he can sort of tone that down a little bit, you may not even get the dissents. It is going to sound a bit dovish. So I think, yes, dissents. I still think the sanctity of the Fed, or the structure of the way the Fed is set up, they're in there looking at the 2 mandates. I don't think they're political. I think it would be a mistake for the market to see 2 dissents as being political because it's just a difference in views in terms of the risk to the mandate.
I was going to say, I was talking with Kit Juckes of SocGen earlier, who basically was saying there's no reason to be talking about cutting, certainly no reason to cut in July. Do you think that there are people who are looking at Waller and looking at Bowman and saying this is political and missing a market narrative that might be unfolding? Is there a real risk in that some of the conversation around it is being distorted because of the concerns about what is political and what's not?
Great point. I sort of, you know, if we didn't have the political background, I think the intellectual argument that Governor Waller is making is actually very sound. He's saying, look at under the hood. Private hiring is slowing. It's highly concentrated. Look at JOLTS. You're not seeing any signs of wage inflation. This is very different from 2020, 2021 when inflation was taking off. He's highlighting what economists will tell you, that tariff inflation tends to be a price level shock, one-off shock. So I think there's a very solid intellectual argument for cutting, you know, not 200, 300 basis points. I think that's where we can, if you have the dissents where people are saying they should cut 300 basis points, that I think does look political. If the argument is let's just take the level of restrictiveness lower, let's get to neutral, if that's 3 or 3.5, I think that's a very valid argument because the economy, there's no question the economy is slowing. We're not into recession, but if we're slowing at sub-trend, Fed funds shouldn't be here. It should be closer to 3.5. So I actually think, yes, I think the market may be saying, well, this is just auditioning for the next Fed chair. I think it's unfortunate because there is a real debate, and I'm sure the Fed is having that debate as we speak, that let's look at the 2 sides, let's look at risks, and do we signal that the risks are shifting? I think that's what I'll be watching for.
All right, we'll see what that decision brings at 2 p.m. Eastern today. Priya, so wonderful to speak with you. Thank you for helping us set that up. Priya Misra of JPMorgan Asset Management, and you are watching Bloomberg.
the Chinese deputy minister did say that we had agreed on a pause. We have not. Nothing is agreed until we speak with President Trump.
U.S. Treasury Secretary Scott Bessent speaking after 2 days of trade talks with his Chinese counterparts in Stockholm. For more, we're joined by Bloomberg's Brendan Murray, who leads our global trade coverage. Brendan, what is the latest? How close are we to an extension or even a deal?
Well, Secretary Bessent said this decision is going to be up to President Trump. They're going to go back to Washington and brief him on the talks today. The body language in the press conferences afterwards was one where you got a sense that the talks were cordial but not warm, and not a whole lot of progress was made. So the decision goes to President Trump about whether to extend for another 90 days is one option, according to the U.S. officials that we spoke with. So we would expect some kind of clarity on that one way or the other, but it would be a surprise if he didn't extend it. That would just create a whole lot of more uncertainty for markets and businesses that are already facing a lot heading into this Friday deadline for these separate reciprocal tariffs on the rest of the world.
To that point, Brendan, where might we see more deals get inked before the Friday deadline?
So the three deals that we're watching that seem to be close are there's been one with India that has been close to the finish line that they're going to try to get over the line by Friday. South Korea is also furiously trying to get a deal that resembles what Japan got, and Thailand is also expecting something before Friday. The Swiss here in Europe think that they're in the queue near the front of the line too, but we'll have to see whether the White House can pull all of these together with just 2 days to go.
Yeah, it's a whole lot and not a lot of time. Brendan, thank you very much. We'll catch up with you throughout the rest of the week, Brendan Murray. It's also a busy week of earnings, and there, Starbucks rising in the pre-market trade this morning, up 4.7%. That's despite sales and profit that fell more than anticipated. The CEO says the company's turnaround is ahead of schedule. For more, let's get the latest with Bloomberg's Sabah Meddings. Sabah, what did we hear from Starbucks? Why the rally this morning despite some of the weakness in the figures?
Yeah, it was fascinating to see the results, actually, because like you say, there was a fall in comparable sales. But I think what investors are really focused on is the green shoots of what we saw from Starbucks. They talked about how they've got this kind of crucial target for serving customers in drive-through locations under 4 minutes. I think it was sort of just hovering above 3 minutes. There's a $500 million investment in labour, getting more workers on the shop floor, sort of improving rotas, things like that. Brian Niccol, the CEO who joined in September last year, he really wants to kind of create this more cozy look at Starbucks. And he's got his work cut out. They've got to reverse sort of several years of declines in sales. And it is a tricky time because, obviously consumers in the US are squeezed. They will have to look at prices a little bit. But, another green shoot also investors are responding to was China, which does look to be sort of signs of improvements there in terms of sales. And Brian Niccol said on an analyst call that he had 20 parties that were interested in a stake in the China business, which was reported on Bloomberg.
Of course, Brian Niccol, formerly with Chipotle, Sabah, which you and I believe spoke earlier this week about how poor some of the earnings have been. As you look at some of these consumer companies, both across the U.S. and Europe, what has been distinguishing between those who are able to cope with the current environment of uncertainty, maybe consumers getting a little bit more cautious, and tariffs on top of that?
Yeah, for consumers, it is really, really tricky. And I think particularly what you've seen in the US is when there are sort of threats on tariffs, people are pulling back a little bit, is how much ability these companies have to push through prices. I think perhaps talking about Heineken, what will the impact of tariffs be, whether it's sort of packaging, raw materials, how much sort of price elasticity they have. I think when Brian Niccol joined, he sort of said he was conscious of not putting up prices. And today there was, he will have to do that in some sort of some measure, but we'll be a little bit cautious about it. So that'll be a really interesting one to watch.
Sabah, thank you so much for that. That is Sabah Meddings. Now, in the next 2 days, $11 trillion worth of market cap of companies are set to report. Now, the bulk of that, it's going to come from the big tech players. Just today, Microsoft, Meta, Qualcomm, they will be releasing results after the market close today. Back with us is Valerie Teitel. Valerie, what are we expecting from the tech giants today?
Well, look, for both Meta and Microsoft, it's going to be a fair amount of attention on their CapEx guidance after Alphabet last week raised their full-year CapEx by an extra $10 billion. So that is going to be a theme through these earnings reports for big tech. But let's focus in on Meta for a bit, because it's all about whether the CEO, Mark Zuckerberg, can convince investors that this AI spending is justified. Remember, it was just a month or so ago that he spent $14 billion in an investment with Scale AI. We also know that he's been building out this AI superintelligence team, with some of these compensation packages being worth over $200 million. It feels like it's not a day that goes by that we haven't heard that Meta has poached yet another AI researcher from a firm. Yesterday was no different. Apple lost the fourth AI researcher to Zuckerberg's AI superintelligence team. So it's about weighing up these expenditures and these kind of costs with the revenue they're currently making on their advertising business, and whether Zuckerberg can convince the markets that it's worth it.
Valerie, at the same time, likely what we got from Alphabet last week is what we'll get this week. Just unbridled spending on things like data centers and, to your point, talent. When you look at the overall environment and what this does for the economy, how important is it that we continue to get, at some pace, capital expenditures coming from the tech giants?
Well, look, this extra boost to CapEx will essentially boost everybody who's within their pipeline. I mean, especially looking at Microsoft. I mean, a lot of the attention is going to be on their cloud business as well, but their CapEx guidance is something that's going to be of focus. Now, remember, when it comes to Microsoft, their cloud business is about the sales that come from these practical AI applications. Remember, it's tie up with OpenAI's ChatGPT. If it's able to capitalize on just giving these businesses these kind of tools to help AI, that's been something that's boosting Microsoft's bottom line. But there could be something that clouds the Microsoft earnings, and that is what happened last week when it came to that cybersecurity breach by Chinese hackers. We did hear from Microsoft spokesperson that the impact was minimal, but it might be a key concern for not just their clients, but for investors if Microsoft can convince them that their cybersecurity measures are rock solid.
Valerie, thank you very much for that preview. We'll see what those earnings bring after the bell today. Bloomberg's Valerie Teitel. Coming up on the show, there are no shortage of market events to look out for this Wednesday. We could probably spend an hour just reading you the calendar, but we will have your trading diary for you up next on your brief. Stay with us. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your very busy trading day. First up, we're going to get ADP employment data. That comes at 8:15 a.m. Eastern. GDP and a quarterly refunding announcement at 8:30 a.m. And then, of course, it's Fed Day, in case you forgot. The latest rate decision coming at 2 p.m. Chair Powell's news conference will come at 2:30 p.m. Will we get 2 dissents? It would be the first, if we do, of getting more than 1 dissent since the 1990s. And a deluge of earnings after the market closed. That includes Meta, Microsoft, Qualcomm, and Ford. But just to be clear, we have a lot of earnings alongside that. And already earnings we had last night moving this morning in the pre-market. Starbucks, one of them. Better than expected net revenue. Recall they have a new CEO that they poached from Chipotle. They say that their turnaround plan is on schedule. Those shares up more than 4.5%. Mondelez, those shares, though, are down this morning 2.5%, just thereabouts. It sees weaker North American sales. It did affirm its guidance, though, for the year. Then there's Seagate. That's extending what it had of double-digit losses. Post-earnings declined 6.3% is where we stand this morning. 2026 revenue and EPS fell short, below analyst estimates. Let me just set you up with how this bond market is looking before that Fed decision, because it was a big rally yesterday. Some questions of would yields be capped in today's quarterly refunding announcement. Also softer JOLTS data. We're little change this morning, but your 10-year yield hangs around at 4.32. Your 30-year yield at 4.87 after the biggest rally for duration since June. All right, that's it for your Bloomberg Brief. Surveillance is ahead. This is Bloomberg.